Hey traders, welcome back to FX Smart, the channel where we break down complex trading strategies into clear, actionable setups you can actually use. Today, I'm going to show you a complete trading plan based on the smart money concept, using order blocks, fair value gaps, and a top-down analysis that starts from the higher time frames and drills down to the 5-minute chart. If you want to learn a consistent method to catch high-probability trades with solid risk-reward ratios, then stay with me to the end of this video. Let's jump in. This trading plan is specifically designed for day trading, meaning traders open and close their positions within the same trading day. No trades are held overnight, which helps avoid the risks associated with overnight market moves. The goal is to capitalize on short-term price movements during the day. When compared to swing trading and scalping, day trading offers a balanced approach. The chart below highlights the key advantages. Unlike scalping, which requires constant monitoring and exposes traders to rapid fluctuations on very low time frames, and unlike swing trading, which involves holding positions overnight and over multiple days, day trading provides frequent opportunities without the added pressure or exposure. This strategy also integrates seamlessly with smart money concepts, enabling traders to make highly precise entries using tools like liquidity zones, order blocks, fair value gaps, and market structure shifts. To trade successfully using this strategy, it's essential to have a solid grasp of the most recent developments in smart money concepts. These ideas are the foundation of the entire system, and your ability to apply them accurately on the chart plays a key role in achieving consistent results. Let's begin with supply and demand. These zones on the chart highlight areas where significant buying or selling activity occurred, leading to a sharp price movement away from that level. Typically, the point where this aggressive move starts is marked as a supply or demand zone. When the price revisits this area, we often expect a reaction driven by the previous behavior of market participants. To identify strong and trade-worthy zones, there are a few critical elements you must consider: inefficiency, break of structure, and the push distance. These components play a crucial role in confirming the validity and strength of a supply or demand area. Inefficiency happens when price moves rapidly away from a level, leaving behind an imbalance between buyers and sellers. This imbalance can often be seen as fair value gaps, spaces between consecutive candles where trading activity was skipped. These gaps indicate a shortage of supply or demand at that area, highlighting it as a possible point where price could reverse. Break of structure, or BOS, occurs when price pushes beyond a significant support or resistance level. This movement reflects a change in market sentiment and helps validate the strength of the nearby supply or demand zone. Each time price breaks a structural level, it often points to the likelihood of a continuing trend. The push distance refers to the extent price travels away from a zone before pulling back. A greater push distance typically indicates a stronger rejection, which adds more credibility to the zone. By evaluating all these elements, inefficiency, break of structure, and push distance, you can better recognize high-probability supply and demand zones for your trades. Here's an example of a strong demand zone. When applying zigzag analysis to the chart, we can observe a series of highs and lows marked clearly. The most recent impulsive move satisfies all the conditions of a high-quality zone. It created a fair value gap, broke through previous market structure, and drove the price higher by a significant distance compared to earlier movements. If the price retraces back into this zone, there's a greater likelihood it will reject the area and resume its upward movement. However, if the price breaks and closes below this strong demand zone, it suggests that buyers failed to defend the level and that sellers have gained control. This shift signals a potential end to the uptrend and the beginning of a possible reversal. Therefore, when the price breaks through a strong and well-defined level like this, it clearly indicates a shift in market structure, signaling that momentum has now shifted in favor of the sellers. This situation is referred to as a change of character, indicating a shift in market sentiment. However, a change of character isn't always reliable. It becomes invalid in two common scenarios. At times, specific market structure conditions can make this shift misleading. Let's go through it step by step. In this case, we're looking at a major swing low that led to a breakout. At first glance, a break below this level might appear to be a valid change of character. But if we examine the chart closely, especially the left side, there's something important to notice. This level aligns with a significant liquidity zone. Here's what that means. Many traders likely entered long positions around this level and placed their stop losses just beneath it. As a result, there's a large pool of liquidity sitting below that point, waiting to be triggered. Smart money is well aware of this. To target those stop losses, the price is often pushed lower to sweep that liquidity before quickly reversing and moving back in the original bullish direction. This brings us to the main point. When a major swing low is located in a liquidity hotspot, a break below it is often just a liquidity grab, not an actual market reversal. So, we shouldn't treat this as a true change of character. If the price returns back into the previous range after this liquidity sweep, it presents a strong buying opportunity. Why? Because the overall trend is still bullish, sell-side liquidity has been cleared, and the next logical target becomes the buy-side liquidity. As smart money traders, our aim is to position ourselves after the stop hunts, once the real move begins. Now that's just one part of the equation. Let's explore another key concept that can also invalidate a change of character, the mitigation of fair value gaps. As a smart money trader, spotting FVGs should be one of your primary tasks when analyzing the chart. These areas often act like magnets, drawing the price back toward them. Typically, before continuing in the direction of the trend, the market will retrace to fill these imbalances. That's why fair value gaps are such crucial zones to monitor. They're especially powerful on intraday timeframes like the 4-hour, 1-hour, or even lower. But here's where things get more interesting. Let's revisit the earlier example. If you take a closer look at the left-hand side, you'll notice an unmitigated fair value gap sitting just beneath the major swing low. In cases like this, price often retraces to that FVG zone simply to fill the imbalance. This kind of pullback doesn't suggest a true trend reversal. It's just the market rebalancing itself. Here's the key takeaway. Always examine the left side of the chart for any unfilled fair value gaps. Doing so will help you differentiate between a simple gap fill and a genuine shift in market sentiment. By being aware of this, you can avoid falling for false signals and keep your analysis in sync with the broader market context. Now that we've covered that, let's move on to the next topic. Supply or demand, who's really in control? Identifying the market direction is the crucial first step when analyzing any price chart. Your objective is to determine the overall trend and figure out whether buyers or sellers are currently driving the market. When you trade in alignment with the dominant force, be it supply or demand, you significantly improve your chances of making successful trades. How does the system actually work? At its core, this system functions based on mitigations. When price mitigates a demand zone, it typically signals that demand is taking control and overpowering supply. On the other hand, when price mitigates a supply zone, it suggests that supply has taken the upper hand over demand. It might sound simple right now, but as we move forward, all the pieces will start to come together and make perfect sense. Imagine the market is in a clear uptrend, forming a sequence of higher highs and higher lows. Each time the price breaks structure to the upside while leaving inefficiency, it creates a demand zone. These demand zones remain unmitigated until price revisits them, presenting prime opportunities to trade in alignment with the prevailing trend. However, if price breaks below one of these valid demand zones, it signals a change of character. This shift implies two important developments. 1. Supply has taken control over demand, and 2. A new valid supply zone has been formed. From that point on, the market often begins to trend downward, creating new supply zones along the way. This continues until the price reaches the next unmitigated demand zone. At this juncture, a battle between supply and demand typically unfolds, which can lead to consolidation, arranging market moving between the supply and demand areas. Eventually, a breakout above or below this range reveals which side, buyers or sellers, has gained control of the market. Next, we'll dive into a key smart money concept, order blocks. Order blocks are refined supply and demand zones on the chart where substantial buying or selling activity began. These zones are highly significant because they often represent the points where institutional traders or other large market players entered the market, pushing the price strongly in one direction. We typically mark the first candle that created a fair value gap as the origin of the order block. This is based on the idea that the decisive move was initiated somewhere within the candle's range. When the price later returns to this zone, there's a greater likelihood of a reaction, assuming there are still unfilled orders within that area. However, it's essential to understand that order blocks are not guaranteed to hold. They're not foolproof, they are potential zones of interest where price may behave in a more predictable way. Like any other tool or concept in trading, order blocks should be used alongside other confirmations and strategy components to enhance their effectiveness and reliability. Finally, let's talk about top-down analysis, a powerful method that involves examining the market across multiple timeframes to gain a complete perspective. This approach allows traders to align with the overall market direction by starting with a broader view and narrowing down to more detailed levels. The process begins by analyzing higher timeframes, such as the daily or weekly charts. These timeframes help reveal the primary trend, significant support and resistance levels, and the overall market sentiment. Understanding this big-picture context is crucial for identifying where the market is likely to move in the long term. Once the overall direction is clear, we then move down to lower timeframes like the 4-hour or 1-hour charts. Here, we look for precise trade setups, focusing on entries, exits, and confirmations based on the concepts we've covered, like supply and demand zones, fair value gaps, inefficiency, break of structure, and push distance. The key takeaway is to keep the process simple and focused. We don't need to add unnecessary complexity. We just apply the same smart money principles discussed throughout this video directly to the chart, starting from the top and working our way down. This structured approach significantly improves the quality of our trade decisions. In this example, we're analyzing the dollar-yen pair on the daily time frame. On this higher time frame, our main focus is to identify the key supply and demand zones that are closest to the current price. At the top of the chart, we can mark the most recent high, and at the bottom, the latest low. These zones are crucial because, when we shift to lower time frames, we'll see that these levels have previously acted as turning points for short-term trends. So, when the price returns to these areas, there's a high chance we'll see some form of rejection. Additionally, there's something else to observe. If we study the latest impulsive move, we can spot a bearish fair value gap. The candle responsible for creating this imbalance can be marked as a bearish order block. This zone now becomes a potential area to look for short setups. Currently, the price is trading near this bearish order block, which makes it an area of interest. However, the daily time frame is not where we take entries. To refine our trade setup, we need to zoom in to lower time frames, such as the 4-hour or 1-hour charts, to look for entry confirmations and potential short opportunities. In summary, the higher time frame indicates a bearish trend, and there's still room for price to move before it reaches the next significant zone. This top-down approach helps us understand the broader market direction and accurately mark the key levels we need to monitor. Now, let's move down to the 4-hour chart. Just like with the daily time frame, our goal here is to identify the overall market direction and highlight key price levels. On this chart, we can clearly see a steady downtrend, with the market consistently forming lower highs and breaking through previous lows. This clean price action allows us to mark a well-defined support level. The analysis on the 4-hour chart confirms what we saw on the daily. The market sentiment remains bearish. With this in mind, we're interested in short positions that align with the prevailing downward trend, at least until the price reaches the next major levels below. However, despite the setup, there's still no strong confirmation to enter a trade directly from the daily order block. So, to fine-tune our entry and get more detailed insights, we'll need to zoom into the 1-hour chart. On the 1-hour chart, things begin to shift. Unlike the higher time frames, the short-term trend here is bullish. The most recent impulsive move left behind an imbalance, highlighting strong demand pressure. We identify the candle that caused this imbalance as our order block zone. For added precision, we can refine the zone by including the wick of the following candle. Once price returns to this 1-hour order block, we anticipate a battle between supply and demand. If the price breaks and closes below this zone, it indicates that supply has taken control. On the flip side, if demand holds, we could see the price push higher, potentially breaking above the daily order block. In this case, the price breaks below the 1-hour order block, signaling that supply has gained the upper hand. This is a clear indication that the short-term bullish move has ended and that price may continue to drop, aligning with the bearish direction from the higher time frames. Now, how do we position ourselves for a trade? We wait for new bearish order blocks to form. Set a sell limit at the newly created order block and place your stop loss above it, giving the trade enough space to avoid early stop-outs. Take partial profits once the trade reaches a 1-to-2 risk-to-reward ratio and let the rest run toward the next significant levels to maximize potential gains. And here's a crucial reminder: patience is one of the most powerful traits a trader can have. Waiting for high-quality setups is not just part of your strategy, it's a discipline. Many traders, especially beginners, fall into the trap of overtrading or forcing entries out of fear of missing out. But in reality, consistency and profitability come from focusing on the best opportunities, not from taking every setup that appears. Now let's take a look at another example, this time on the Euro to Japanese Yen daily chart. First, we start by marking the key levels. At the top, we have the recent highest price, which was clearly rejected, making it a strong resistance zone. At the bottom, there's a potential support level. If the price returns to this zone, we may see a reaction. In addition, there's an important level in between that has historically acted as both support and resistance. Since this level has been respected multiple times, we mark it as a key zone. Currently, price has broken below this intermediate level, indicating potential bearish momentum. Based on this structure, we expect price to continue dropping toward the next significant support level ahead. This type of level-based analysis helps us anticipate possible price reactions and better align our trades with the broader market structure. Now, let's zoom into the 4-hour chart. On this time frame, we can clearly see a smooth downtrend, which confirms the bearish direction of the higher time frame. This tells us that we should only be looking for selling opportunities to stay aligned with the overall market sentiment. The most recent price move has created an imbalance, and we can mark the candle responsible for this move as a potential supply zone. To make this zone more accurate, we also include the wick of the next candle, since that's where the imbalance begins. This gives us a fairly large area to monitor for possible trades. If the price returns to this supply zone, we expect a reaction, likely a rejection, somewhere within it. Our next step is to wait for price to enter the zone. Once that happens, we'll shift down to the 1-hour chart to refine the zone and look for precise short trading opportunities. On the 1-hour chart, our focus shifts to identifying order blocks and placing our sell limits. At this stage, we can refine the 4-hour order block to a more precise zone. However, we're not ready to take short entries just yet. While the higher time frame is clearly bearish, the 1-hour structure is still showing signs of a bullish trend. Before entering any trades, we need to wait for this short-term bullish uptrend to come to an end. Now, let's observe the price movements closely. At this point, the price confirms a change of character, which signals a potential reversal. Additionally, an order block has formed, giving us a well-defined entry zone. With both the higher time frame and lower time frame now in agreement and showing bearish sentiment, we can confidently execute a short trade. In this strategy, the 1-hour chart serves as our entry time frame. It allows us to refine our trade setups and achieve more precise entries. However, if you want to go even deeper, you can zoom into lower time frames like the 15-minute or 5-minute charts to find additional confirmations. This approach can help you enter at even better prices, ultimately improving your risk-to-reward ratio. It's important to note that in this analysis, we didn't incorporate session volume or news events. These elements can have a significant impact on price, especially during key economic announcements or times of high market activity. Incorporating session volume can help you identify periods of high liquidity, increasing the reliability of your setups. Likewise, staying informed about upcoming news can help you avoid unexpected volatility that may disrupt your trades. Practicing these concepts on your charts will definitely enhance your market analysis, strengthen your understanding of price action, and optimize your trade entries. Guys, I hope you found this video valuable. If you did, please go ahead and smash the like button, drop a comment below to share your thoughts, and subscribe to FX Smart for more premium trading content. For even deeper education on smart money concepts, make sure to check out our Smart Money playlist. It's packed with step-by-step tutorials to take your trading to the next level. Thanks for watching and see you in the next episode.